Thank you everybody for joining us. We have a presentation here which hopefully you can see in front of you, and moving to slide 2. If Andy could kindly move that along. We are a leading professional services consultancy with multiple service lines across 2 divisions. The first division, the larger division, is insolvency and advisory with a run rate of approximately £76 million. And that covers corporate and personal insolvency, corporate finance, and financial advisory. Financial advisory consists of a number of different service lines: debt advisory, due diligence, transaction support, accelerated corporate finance, pensions advisory, business and financial restructuring, forensic accounting and investigations, and finance broking. Our second division is our property services division, with a run rate of £24 million, and that covers valuations of property, business assets and plant and machinery, transaction services, which is principally selling property and other assets, and also a property consultancy and planning and management business, which is similar to what you'd expect to see in a large firm of commercial chartered surveyors, so covering many different activities, such as building consultancy, lease advisory, commercial property management, specialist insurance and vacant property risk management, transport planning and design. Our model is to be in the local business community, so we have a comprehensive network of offices around the country. We have almost 1,000 partners and staff, and our senior people are qualified as either licensed insolvency practitioners and/or accountants, chartered surveyors and lawyers. And over the last 5 years, we have a strong track record of earnings growth with a cumulative average growth rate of 20%. Moving to the next slide. We consider we're well placed with a counter-cyclical focus. 70% of our activities, we believe, are counter-cyclical. And that includes, for insolvency and advisory, the corporate and personal insolvency business, business and financial restructuring, debt advisory, and accelerated corporate finance. And for the property business, the valuation and sales of distressed assets, specialist insurance and vacant property risk management brokerage. 20% of our activities are cyclical, so corporate finance and finance broking for the insolvency and advisory business, and valuation of commercial properties, commercial property agency, asset sales, business sales and transport planning for the property division, which leaves 10% of uncorrelated activities: due diligence and transaction support, forensic accounting and investigations and pension advisory for insolvency and advisory, and for property, property auctions, building consultancy, commercial property management and lease advisory. So this 10% of uncorrelated activities we believe to be pretty consistent throughout the economic cycle. Moving on to the next slide. Strong financial track record. Over the last 5 years, we've seen average revenue growth year on year of 14% from organic development and acquisitions, and that's split roughly 50-50 between organic growth and acquired growth. We've seen progressive margin enhancement from approximately 12% to 15% over the period. And the cumulative average earnings growth in adjusted EPS is 20%, which is significantly ahead of the insolvency market and is achieved by the development of market-leading insolvency practice, increasing our market share to 12%, again through organic growth and acquisition, the expansion of the advisory services, and the buy and build of the property services. We have a strong balance sheet with consistent operating cash generation and a net cash position at 30th of April 21. Our dividend growth of 8% since 2017 has been whilst increasing dividend cover. Moving to the next slide. Our value-enhancing growth strategy is to enhance shareholder value through the delivery of strong, sustainable financial performance. Focusing on organic growth, that's the retention and development of our existing partners' employees, investing in them. Recruitment of new talent with a focus on work-winning senior people who can bring a following with them. enhanced cross-selling of our service lines and expertise to a wider client base, and investment in technology and process to enhance working practices and improve the services of our client. And that's both in terms of generating work and process to complete assignments, particularly on the volume end of the practice. Our acquisition strategy is value accretive acquisitions in any of the following segments: insolvency to increase our market share, property services to enhance expertise or geographical coverage, and complementary professional services to continue the development of the group and its service offering. So our strategic objectives are, number one, to increase the scale and quality of our businesses, both organically and by acquisition. Secondly, to deliver sustainable profits growth, enabled increased shareholder value. Three, to maintain our strong financial position, enabling the investment in and development of the group and our people. And fourthly, to continue to ensure high standards of corporate governance and responsibility. Looking at the business recovery and financial advisory business, this is a £64 million turnover business at the moment. We are the UK's leading independent business recovery practice by case number, handling the largest number of corporate appointments in the UK, approximately 2,000 new appointments per year. That is our current run rate following the acquisitions made over the last few months. And we focus very much on the mid-market and smaller companies. 88% of our insolvency work is corporate, with the balance of 12% being personal. Our attempts are always to try and save a business in the first instance if possible. Where it's not possible, which is often the case, then our job is to realise the assets and distribute them to creditors. All formal insolvency appointments require a licensed insolvency practitioner. We have 104 in the business, of which 92 are active, providing advice to clients. The sources of our work are the professional community, referring their clients who have problems to us. So that's accountants, lawyers, and to an extent bankers. Financial institutions we work with very closely on their panels. We get internet inquiries and direct communications. This is about 10% of our work. And we have existing contacts of the firm that generally re-refer work to us. Our basis of remuneration, typically on the basis of hours worked, with fees paid from assets realisations. In limited occasions, it's based on a percentage of asset realisations. So we are dependent upon an element of contingency there, what the assets realise, and we pre-agree a percentage of that. And our fee basis and levels are ultimately agreed by creditors. We have over 5,000 accountant contacts referring work to us. We have 31 principal offices around the country dealing with insolvency in situ, but in addition to that, we have local satellite offices providing marketing and consultancy advice. We have over 500 staff in the insolvency division. Typically, cases last 2 to 3 years, although larger cases can last 5 years and beyond. And we now have 5 offshore offices and international capability through BTG Global Advisory. Moving on to financial advisory, a 12 million run rate practice, services of advisory, corporate finance, finance broking, forensic accounting and investigations. Often these services are complementary to the business recovery department, and we work together with them using similar resources or similar contact base for referring work. There is an opportunity to broaden and develop these service lines, which we're actively doing at the moment. Our most recent addition was the MAF Finance Group, the introduction of a finance brokerage into our stable of activities. Our clients are marketing direct to businesses to give them advice in various areas. Again, the legal and professional community refer their clients to us. We work with banks and financial institutions and the investment community, particularly with regard to corporate finance. The basis of remuneration is typically hours worked. However, on corporate finance, it tends to be a small retainer fee and a contingent fee on the success of a transaction. And for finance broking, it's commission on finance raised. We have 82 dedicated staff for financial advisory, but in addition to that, there are another 24 staff members who work between insolvency and advisory. Springboard Corporate Finance is our corporate finance business. We have retained that brand because it is extremely well known in the corporate finance arena. And MAF Finance Group is our very recent addition, in fact, last month, which is the finance brokerage, which eventually may change its name to BTG Advisory, but there's a lot of goodwill associated with that name at the moment, so we will be retaining it for the short term at least. And we operate from 6 principal offices around the country, and 4 of those offices are shared with the insolvency business. Moving on to the next slide. In terms of multiple growth drivers, a strong market presence and reputation. Local office network gives us market leadership in the SME marketplace. So that's being close to that local community, which refers work to us. Strong reputation and expertise gives access to larger cases. An extensive network of national work referrers and a leading digital marketing activity generating work. That's the 10% of the work that we generate direct from corporates via the internet. The SME market provides a base level of insolvency across the cycle, so less cyclical and volatile than the larger cases. But the case profile does include some large fee cases in addition to the volume, and we'll come on to some of those in due course. Our advisory business adds complementary expertise and introductions to larger insolvency cases. And we have internal referrals to the property services division from insolvency, and that's for the valuation disposal of assets in insolvency and the insurance thereon. We have a highly experienced partner group. There are incentives in plans in place, encouraging teamwork and growth. Annual bonuses are based on regional and national profitability, and we have an LTIP in place based on divisional and group earnings growth. We have a track record of developing and promoting through to partner. We support our people with professional training, aiming at qualification in due course. And we have the ability to attract quality fee earners. We are net recruiters of senior people. And in terms of capacity to handle the increase in appointments, which we may well see over the next 12 months, we have somewhere between 10 and 20% capacity within the team to cope with increased levels of activity. I'll now hand over to Nick to go through the property advisory and transactional services business.
Okay, thank you, Rick. Edison's our property arm, around about a 24 million run rate fee income. 20% of that is valuation work, where we're valuing assets, property, small, medium-sized businesses, machinery and business assets. That's typically for banks, a combination of good book lending, so normal solvent lends, but in addition, we advise in distress situations. And in many cases, the advice on those properties will lead to receivership appointments down the line. 40% of our fee income comes from selling assets for our clients. We sell property, machinery, and other business assets through auctions. They've been exclusively online over the course of the last 15 months. We have a business sales agency, which is effectively an estate agency for small businesses, selling fish and chip shops, coffee shops, and the like. And we have a commercial property agency. The remaining 40% of our income comes from consultancy, planning and management, building and project consultancy, project management, surveys, dilapidations, typical work done by surveyors. We manage commercial properties for our clients. That's collecting the rent and the service charge, managing the service charge on the office buildings. We have lease advisory, specialist insurance brokerage, which Rick mentioned previously, insolvency, commercial and property investor insurance. And we also have a vacant property risk management solution, which is important in many insolvency appointments. And we have a transport planning and design consultancy. A very broad client base, banks and lenders, insolvency practitioners, owners of property, public sector bodies, landowners and the like. And the way we get paid, typically in valuations, building and property consultancy, transport planning will be on a quoted fee basis. Where we're selling assets for clients, we'll typically be paid a percentage of the realizations. And in the insurance brokerage, we'll receive a commission on insurance policies written. And we've got just over 300 dedicated staff working in Edison's with a significant insolvency-focused plant and machinery team, and Pew is the largest regional property auctioneer in the UK. Turning to the next slide, our property business has proved to be very robust over the course of the last year in a challenging environment. We have a very strong referral network and client base, which leads to high levels of repeat business. Insolvency expertise is a key part of this division. It accounts for over 10% of its fee income. That's valuing and selling plants and machinery from insolvency. On commercial property, we act as receivers and we sell those assets through our auctions and our agency team, and our specialist insurance and vacant property services as well. The public sector has been a key focus of growth for us in recent years. It's now approaching 20% of the fee income. You may have seen in our announcements over recent years the work we do in the education sector. This is working with schools and colleges to develop their budgets for managing their property estate, putting those budgets forwards to government and other funding bodies, and as and when funded, working with the schools and managing that work. And that's been a key area of growth for us over the last 3 years. We gained a panel position with Homes England in 2019, which has been very successful for us and has generated auctions, agency and consultancy work. We now work for the NHS, doing some lease advisory work, and in local government, there are tender opportunities for property management, and a large number of the lots that we sell through our auction are sourced from local government as well. Banks and financial institutions are around about 20% of the fee income as well. The panel positions with those lenders provide barriers to entry, and we've received instructions from about 24 institutions over the course of the last year. So that's the main clearing banks and also a myriad of smaller specialist lenders. And our property management contracts lead to spin-off advisory and agency instructions. And we're continuing to grow our client base and our referral network, which is helping to develop this business. Looking at our most recent acquisitions, we have done 4 acquisitions in this calendar year. 2 significant insolvency acquisitions. We acquired CVR in January, which was followed by DRP, David Rubin and Partners, in March. These 2 acquisitions together have significantly grown our insolvency practice. It's added around 20 million of fee income and 4.5 million of profit pre-synergies. And finally, having realised those synergies, we'd expect that profit to exceed 5 million. In addition to the overall growth in the practice, it's been a material expansion of our London team, which has more than doubled in size. And we've also seen an expansion of our advisory services, forensic, expert witness and pensions advisory. And we've brought our first offshore operations into the group as well. So we now have offices in the BVI, in the Channel Islands, Jersey and Guernsey, Gibraltar and Cyprus. And the combination of these 2 practices into Begbies Traynor gives us some very exciting opportunities as we move forwards. We acquired a small property consultancy in London, HNG, in February. Commercial property management, commercial agency, and lease advisory, banging the core service lines which Edison's provides. And as Ric mentioned, in the start of the new financial year, MAF Finance Brokerage. They operate nationally from a HQ in the Midlands, and they arrange finance for investments in new asset purchases, as well as refinancing and restructuring existing facilities. And over the course of the last 12 months, they've raised over 150 million of finance for their clients. They work across a broad range of sectors with a large panel of banks and specialist funders. And this complements our existing services, both advisory and the transactional areas where we're selling property and plant and machinery assets. And it deepens the group's relationships with lenders. And this business has got some pretty ambitious growth plans, which are structured into the considerations as a pretty significant earnout in this transaction, which reflects the growth plans of the management team. I'll now hand back to Ric to look at some of the more significant cases we've handled recently.
Thank you, Nick. While most of our assignments fall into the 10,000 to 100,000 fee range, we do get some larger ones. And this is 6 examples here of those across our various service lines. Very quickly looking at them one by one. The first one, administration of a property lender. That's principally an insolvency case, but involved a lot of activity for our property services division. So that was a secondary loan book that we had to realise. So we worked with property to realise those assets and return a significant amount of cash to the secured creditors in that particular case. And the likely fee is going to be 3 million plus for administering that administration, which is one of the larger ones and likely to therefore be more like 5 years than 3 years. The second case, advisory project for financial institutions. That's something which we've been doing for a number of years, working with one of the big financial institutions, helping them with problem debt, which they wanted to remove from their books, but without ideally litigation or formal insolvency, and working with them on 500 cases so far. We've managed to resolve 420 of them without the need for litigation or formal insolvency. And that contract has been worth an annual fee income of about £1 million a year to us. The next one down, corporate finance, a typical example of corporate finance activity. This is the Springboard corporate finance, so it's not involved with distress sales. It's very much successful businesses looking to realise value. And in this particular example, we sold a business for 80 million with a fee of approximately £1 million. Moving on to the next example, the school improvement projects, which is a property assignment. Nick has covered this in a bit of detail, but this is working with schools and academies to set their budgets and claim funds from central government to maintain their infrastructure. And that's been growing for us as an area of activity over the last 3 years and is now running at in excess of £2 million a year. And the next 2 cases are both examples of contingent insolvencies where we have been appointed. We're working very closely with HMRC as the major creditor. There's been fraud, their assets disappeared, and it's very much a forensic case to try and establish what the assets should have been and then to chase them by means of litigation, often around the world, and realise value. So both of those cases will yield fees in due course in excess of £1 million. So that's an example of some of the larger stuff we do. But as I say, the emphasis is on our routine work, which is in the 10,000 to 100,000 fee range. Moving on to market consensus forecasts. In terms of the year that's just completed, the end of April 21, expected revenue of £83.7 million, adjusted pre-tax profit of 11.5, and adjusted EPS of 6.8. That's all subject to audit, which is going on at the moment, and we intend to announce our figures fully post-audit in July of this year. And in terms of market consensus for the year that we've now just entered, we're anticipating revenue of £101 million, adjusted profits, big increase to 17.5 million, which reflects the acquisitions we've done in the last 4 months. And again, a big increase in adjusted EPS to 9.2. Moving on to summary and investment case. A strong track record of cash generative, profitable growth with a well-established progressive dividend policy. We've been AIM listed since 2004, so highly experienced board and senior management team. We've been around a long time and been through a number of trade cycles. Long established corporate structure with separation of equity, management and fee earners. Strongly positioned in countercyclical activities, representing 70% of total revenue. A market-leading business recovery practice, taking the largest number of corporate insolvency appointments in the UK, with a focus on mid-market and smaller companies, a strong referral network across the group leading to high levels of repeat business, a diverse income stream providing multiple sources of growth across the economic cycle in fragmented markets, and a growth strategy of organic investment and value accretive acquisitions across our service lines. With the benefit of our recent acquisitions and organic growth opportunities, we are well positioned to deliver the anticipated material growth in earnings in the new financial year. That's the end of the presentation. Thank you very much. Hopefully there are some questions which we'll be happy to attempt to answer.
Great. Yeah, very, very thorough. Thank you, gentlemen. And there are indeed a number of questions, a lot of which really relate to your acquisition strategy and the opportunities out there. So I might read through them all at the same time. How committed are you to further acquisitions, and how important are they to your ability to grow the business, particularly if insolvency numbers were to remain relatively subdued?
Thank you, Andy. Well, in terms of our acquisition pipeline, it is significant. It's very much part of our model, as we've covered in the presentation, to grow by acquisition as well as organic growth, with half of our growth over the last 5 years coming from acquisitions, and we suspect that will be maintained, if not enhanced, given the 2 large acquisitions that we did in the opening months of calendar 21. In terms of the insolvency business, we have performed well in the last year despite a very subdued marketplace as a result of government furlough schemes, loans, etc. Well, we've seen numbers drop something like 35% over the last year in terms of insolvencies in the marketplace, yet our turnover has stayed very healthy. So we don't think we're very dependent upon an increase in activity in the insolvency market to see the business move ahead. And indeed, we're very much looking to build a model where at any point in the economic cycle, we have engines of growth within the business, be that the insolvency business, advisory, or the property side of activities.
Okay, thank you very much. And in terms of the balance of the group, is it a case that the timing of these deals are opportunistic, in that I'm sure vendors are waiting for the right time to sell? You will perhaps follow a business for many years before that opportunity comes along. And for instance, you've been able to close this year 2 very large insolvency transactions. In terms of balancing the group, how would you like to see revenues split between the anti-cyclical and the growth business if you were looking 3 years ahead?
Well, I think what we would like to achieve is to have a balance where across the cycle, the service activities are 50% counter-cyclical, 50% not. Obviously, at any point in the cycle, it might well be that balance isn't 50-50, because if, for example, we're in a recession, the insolvency business is likely to be more than half of the business, but equally, at times of economic boom, it may well be the insolvency dips below 50%, but ultimately to have that sort of balance. So at the moment, our counter-cyclical activities are approximately 70% of our 100 million run rate, so 70 million. So to have 70 million of other activities in due course to balance that up would be, we think, a sensible strategy and a sensible balance of services across the group.
Okay, thank you. And let's talk a little bit about sort of government policy and furlough potentially finally ending. What do you think of the market at the moment? The market for insolvencies, should furlough be rescinded, and also implications for the property market in that respect?
Well, I think in terms of insolvency, undoubtedly we'll see an increase in activity. It's artificially been held down by furlough and other activities, government support measures, quite right in my opinion, during the pandemic. But when they fall away, we will see at the very least a catch up of those businesses that would have become insolvent over the last year, nothing to do with the pandemic, but just in any event, we're coming towards the end of their life. We'll expect to see those move into insolvency. And in addition to that, there will be other businesses which went into the pandemic relatively healthy, or certainly with the ability to survive, that are now coming out of it with debts. It'll be very hard for them to deal with. So I think we will see an increase in activity over the course of the next 12 or 24 months even, as a result of what's happened over the last year or so.
Okay, thank you. Maybe a couple coming up for you now, Nick, if you want to unmute yourself. Thank you. The group has consistently invested in its infrastructure, particularly in IT. Can you just update the state of that, how much work there is still to do and the benefits that you've accrued, and how much that has been a factor in, touching wood, what seems to be very successful integration in the many acquisitions you've done?
I think the investment that we've done over recent years to a large extent has been around the infrastructure. So that's enabled us to work pretty seamlessly with the reverting to home working. So that included electronic document management. So all files are now available electronically, which meant that when people did end up working from home, they could still get access to everything that there was a few years ago have needed access to paper files in the office for. So around that area, accessing remote desktops and the robustness of our infrastructure has been a key area. I think moving forwards, following the appointment of Peter Walquist to the board as a non-exec, who's got a lot of IT experience, we're now looking at how we can use technology to operate in a more effective way moving forwards and maybe make elements of our work more efficient. So I think that's probably the next stage of our development within IT.
Okay, thank you. And again for you, Nick, can you talk a little bit about the cash implications, particularly for working capital, for the cycle that is involved in insolvency when you get paid at the end of the process? And if there was to be a surge in insolvency work, how would that impact your short-term cash position?
Well, you're absolutely right, Andy. We get paid from the assets that are realised. And on average, across our cases, it takes about 6 months from doing an hour of work to getting paid. And that's sort of within the structure of the business, and that's what we see coming through our cash flows. Clearly, if we see an increase in work being done, there is a lag in terms of being paid, which may need some working capital finance. And we've got a significant facility in place that would fund that. But in the short term, what we've seen over the course of the last year is very strong asset recoveries, which has given us a very positive cash flow over the course of this year. But we see the RCF that we have with HSBC as being important to have just in case we need any kind of working capital buffer in place to fund that short gap between doing the work and getting paid.
Okay, thank you. Another numbers question, you're very popular. In terms of consensus EPS forecast, could you just clarify if they take account of dilution to come, as a lot of the consideration you pay for your acquisitions is deferred or dependent on earnouts?
Well, there'll be two numbers within the broker's forecasts. There's the basic, which is based on shares that are currently issued. So the broker's forecasts for the new financial year 22, will reflect the shares that were issued from the placing that we did in March. And then in addition to that, there are shares to be issued, which get accounted for within the diluted forecast. But they're principally shares for options for the senior fee earners in our insolvency team. The earnouts are largely cash-based, so they will be funded through our free cash flow moving forwards, which very, very easily covers those future deferred payments.
Okay. And perhaps the last financial question. Adjusted earnings per share as the common form of measurement. Could you just outline what the adjustments are for, and give a little more depth on how you assess dividend payouts in terms of cover against or cover by earnings, particularly as forecasts in the next year or two are for considerable growth in earnings of the order, I believe, of 25%.
Okay. Well, the adjustments that we make are all in relation to acquisition accounting under IFRS. So anything that goes below the line are either the cost of acquisition, it's the amortization of intangibles that we take on the balance sheet, and also what are termed transaction costs. So this is if we pay an acquisition and we require the vendor to stay with the business for a period to make sure that the goodwill gets transferred, that element of consideration under IFRS also has to be charged to profit rather than treated as goodwill as it would have been a few years ago. So they're the principal items. So the number that we have as an adjusted profit is very much the normal operating profit of the business that we see and we manage as a management team. In terms of dividend payouts, over the course of the last few years, as Ric said, we managed to grow the dividends by about 8% a year. We've done that whilst improving our dividend cover. I think the position that we're in at the moment is that we've got a lot of deferred payments that we need to make, and we've also got a lot of acquisition opportunities, as Ric mentioned. So we're very confident that we'll maintain dividend growth around the level that we've done previously. And I think any increase in dividend ahead of that will be dependent on what level of further investment we want to make into the group.
Okay, and then definitely last time for you, Nick. Margins on insolvency work. Again, we've been speculating about whether there could be an awful lot of that coming down the track. But do you see scope for an improvement of margins that you're achieving, relative to other large players in the insolvency space?
I think there is scope for improvement, and we've seen better, higher margins at other stages of the cycle. So we're around about mid 20% at the moment, and we've seen that go to the high 20s at other stages of the cycle where people are very busy. We're getting good realizations on assets. So I think there is definitely that opportunity for margin enhancement if we see the marketplace move in that direction.
Okay. Right, thank you very much. Now, perhaps a couple of strategic questions to finish that you might want to take, Ric. We have a question, given the range of services that you provide, is it conceivable at some stage that you might actually aspire to be a non-banking lender to SMEs?
That isn't in our plan at the moment, and I suspect there would be many other things that we would look to do before doing that.
Yeah. Okay, nice and clear. And again, strategically, Begbies has reached the position of being the #1 player in the insolvency market by a number of transactions. What do you think are your key differentiators that have enabled the group to reach that position, and where do you see competitive threat?
Well, in terms of reaching that position, it's growing the business and very much having that model of being in the local business community. So we have many more offices than our competitors because we've chosen to be in those locations that perhaps they're not prepared to be. And that's allowed us to network with the local business communities and to give us that volume of activity that we're seeing at the moment. That, together with the work that we've done recently, building our internet presence to get in touch with smaller businesses that don't have a trusted financial advisor, typically their accountant, to turn to when they have a problem. So they are using the internet in order to try and solve their problems. And they find us and we give them that advice. And in most instances, that advice allows them to continue to operate. But in many instances, it means that the sensible thing to do is to instruct us to formally liquidate their business. So, you know, that's where we've got to, where we have got to. And of course, the fact that we are growing by acquisition as well as organic growth. So we are looking to bring in insolvency boutiques and to grow that footprint.
Yeah. And then a final one, you know, as a cash generative group, would you consider share buybacks as opposed to dividends for use of excess capital? I suspect you have plenty of uses for excess capital myself, but I'll let you answer that one, Ric.
Thank you, Andy. Well, I think you are right. For the foreseeable future, we have plenty of uses for that excess cash. We're looking to grow the business. We've got some great opportunities to keep investing in the business. At some point, if we have surplus cash, would we look to do that as opposed to dividends or allied with? I wouldn't say no, but given the fact over the next 3 to 5 years, our strategy is one very much of growth, we'll be looking to use any surplus cash in the business to expand it.
Yeah. Great. Well, thank you very much, gentlemen. Excellent presentation and very clear answers. Thank you to our audience for some very perceptive questions. I would add that for 1 or 2 of the questions where people are looking for direct forecasts and the relationship between earnings and dividends, I suggest you simply look at the research that is available from Equity Development that shows the very good levels of cover relative adjusted earnings to dividend. And in terms of this presentation and the slides that were used, the recording of this will be made available hopefully in the next 24 hours, which can be found on the very informative investor relations page on the Begbies Traynor website, and of course on the Equity Development website too. So thank you all.
Thank you very much.